Let's talk about parent loans. Some of you might have seen these on financial aid award letters, and you might see the term in the media parent plus loans, or you might see the term just plus loans. And it used to be called parent plus loans, which I like much better because it really described what we're talking about. We're talking about a parent loan that's used to pay for college. But now I think they have changed it to plus loans. So let's talk about what these are and how you're eligible to get them. So these are these are loans. I was about to say student loans, but they're not student loans. They're parent loans. But they are loans that parents take out to help pay for the cost of college for their kids. They are available through the federal government, just like the direct student loans that I've talked about in the past. Both federal government type of loans, but very different in some key ways. And the most important way this is different is this is a parent loan. So one parent takes out this loan. You will be eligible to apply for this loan as long as you submit the FAFSA. So again, very important to submit the free application for federal student aid. So once you submit the FAFSA, you will see that the colleges very often will award this on the financial aid award letter. And I just want to take a minute to talk about how much they can award. Because this is a federal loan, there's federal rules that they have to follow. So colleges can offer a parent plus loan in the amount of their cost of attendance, which is their whole sticker price, tuition and fees, room and board, books, and then travel and personal expenses. That whole cost minus whatever financial aid or aid in general they're awarding. So if your child receives a merit award or need-based grants or federal direct student loans, after all the other aid that's being applied and awarded comes in, they take the difference of all of that aid from the cost of attendance, and then they can award or give the parent the opportunity to apply for a loan in that amount. So let me put some numbers to this so that it's clearer. Say a school costs $50,000 all in. That's the sticker price. And from various sources, the college is awarding the student, say, $20,000, right? So 50,000 total cost minus the 20,000 of aid awarded gives you $30,000. So what that means is the school can award a parent plus loan or a plus loan, whatever they call it, in the amount of $30,000. So I'm just going to put a word of caution in here. You want to be really careful because with that example I just gave, $30,000 a year, we'll do the math. If you're going to take that out every year, you're going to be in debt to the tune of $120,000. And as I said at the beginning, this is a parent loan. So the only person that the federal government is going to come after for repayment is the parent that takes out the loan. Only one parent applies and takes it out. It's typically easier to get a federal Parent Plus loan than it is potentially to go to a private bank. So some people that don't have a super high credit score might be more able to get this type of loan. But again, I really want to caution you to be very careful before you make this your college funding strategy. And honestly, a lot of the families that I work with, when I go through this with them, if that's their main strategy when we're in the planning phase before their child is ever applying, I tell them, if that's the only way you can afford this school by racking up 100,000 plus of debt, maybe this school isn't affordable. And that's the planning that I really encourage all parents to do. I'm not going to get into that today. We're really just talking about the parent loans. So that's how the parent loans work. Then the parent applies once it's been awarded. And this is senior year when your child is deciding on what school they're going to actually attend. you'll see this on award letters. But when you see this word thrown around, I want you to understand what it is. So the interest rates are fixed. They change every year, just like the direct federal student loans that a student is awarded. They're tied to the 10-year treasury note. They tend to they always have a higher interest rate than the student loans. So that's how Parent Plus loans work. Please, if you're considering these, do your 4-year cash flow. So you're really planning out, how am I going to cover this? So if you do need to take these loans out in subsequent years, you know how you're going to repay them, and you know that it's affordable for your family. Because most parents that take out these loans, they start paying them off when the child is in college. It's not something that they typically defer. So you gotta look at the 4-year cash flow, and you gotta go in the weeds on this before you just take these out. But I wanted to share this because it is a tool in the toolbox, that I want you to be informed about. And as always, enjoy the journey.